Welcome to Module 3, Puts and More Definitions. The things you're going to learn today are something very different than we've been doing so far. And what we're going to do is we're going to be learning on betting on the market going down. So far, we've been talking about the market going up, and we've been talking about how to make money when the market goes up. Now we're going to talk about betting on the market going down. And basically, we're going to define what are puts, how they are different, and we're going to talk about in the money, near the money, and out of the money definitions. Again, some suggestions for this module is to remember this is new for you. Now, I know that you're starting to catch on. I could tell by some of the responses I get back from the students who have gone through Module 1 and 2, and they're starting to catch on. But remember, this is still new. It's still new, and remember that you will definitely learn if you continue to watch the modules and talk to me as your coach. Remember, don't get frustrated. And also, I would suggest that you open your TD Ameritrade account open on the screen. Of course, if you're using another broker, that's fine. Doesn't matter. Just understand that the screens would be different on the other broker. That's the only reason I suggest TD Ameritrade is because the screens will be the same as the ones I show you. Of course, have a pen and paper and take some notes. As always, I'm going to talk about my disclaimer. Most importantly, stock option trading means that small market movements will have great impact on your trading account, and this can work against you, leading to large losses, or it can work for you, leading to large gains. And you will experience both. Just hang in there and learn. So let's go over a little bit some of the things that we went through in the last couple of modules. First of all, stocks or ownership. You own pieces. If you own a stock, you own a part of the company. All right. Stock options are very different. Stock options are not ownership of the stock. They are ownership of a contract that says that you can either buy a contract, buy a stock at a certain price, or as we started to discuss puts, you can sell it at a certain price. We'll talk about that in a little while. Remember, the biggest things that make the market go up are fear and greed. And when people are fearful, that's when you need to get greedy, as Warren Buffett says. And of course, this creates small movements every day, and the small movements are the option trader's money-making opportunities. Oh, by the way, also fear is called resistance, and greed is called support. So you'll hear this a lot as I talk to you, and you'll hear this as you talk to some other pundits. They'll talk about resistance and support, and these are very important terms. Of course, things that can make the stocks go up and down are things like earning reports. The earnings are reported quarterly and announced the month after the ending quarter. So typically, if a company ends their year in December, not all companies are on an annual or a calendar month. So if they end in December, typically the earnings would be end of January or beginning of February. And you'll start to get the earnings dates pretty easily as you start to follow the stock market. Of course, if a company does well in earnings, the stock typically goes up, but it doesn't always go up, and that's what makes earnings very difficult. And of course, as I've said before, betting on earnings is gambling. There are ways that you can take advantage of earnings season, but betting on earnings is pure gambling, and I would avoid it. Although I'll tell you, I do it, and most of the time, I'm sorry I did it. All right, again, a stock option. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. An option, just like a stock or bond, is a security. It is also a binding contract with strictly defined terms and properties. Of course, the only thing you need to know here is that the option is a contract that gives the buyer the right but not the obligation to buy or sell an underlying asset. And we're going to get into the sell part very soon. So, of course, why stock options? As we talked about before, they use an incredible amount of leverage to control stocks, and you never even have to own the stock. Very important definitions, as we talked about in the last module. First of all, you can execute the option, if you remember the house example, right? You can let the option expire, if you remember again in the house example, or you can sell the option at any time before expiration. So execute, expire, or sell. And of course, as you know, I like to sell my options. I don't execute them at all. Or hopefully they never expire. But it will happen now and then. All right, important definitions. The strike price. The strike price is the price in which you can buy the stock for if you're using calls. And you also see, as we talk about it, we'll talk about what the strike price is in a put in a little while. The time value is how much money you're willing to pay to have the option to buy, or we're going to talk about selling that stock, buying or selling that stock in so much time. And of course, the intrinsic value is what the actual value of the option is worth if you took out the time value. And of course, pricing an option is made of 2 parts, both of those, the intrinsic value and the time value, and that equals the price of the option. And of course, as you know, time value decays every day. Now, remember that the intrinsic value changes with the price of stock. So if the price is going up and you have call options, your value of your option is going up because the intrinsic value is going up. But the time value is going down every day. However, of course, as we talked about, there are some exceptions to time value going down. During earnings season, time value may actually increase. And it increases, and I'm going to tell you more, but we'll talk about it at another time, but I'm going to tell you more that it increases because people are anxious and excited about earnings. So they feel that as you get closer to earnings, well, it's worth more. So up until now, we've been discussing call options. And again, with the call options, we're betting on the stock price going down. With a put option, with call option, we're betting on the stock price going up. And in a put option, we're betting on the stock price going down. All right. And this is a little different. And I want to explain how this works because some people get a little confused by it. And as you start to buy puts, you'll start to understand it quickly. But let me see if I can explain it for you. All right? So basically, someone guarantees that they will buy the stock for a set price. So if you remember, in a call option, somebody guarantees that they would sell you the stock. Well, in this case, someone guarantees that they will buy the stock for a set price. It's basically like a life insurance policy against the stock going down in value. Like an insurance policy against the stock going down in value. In fact, that's exactly what it is. It is an insurance policy against the stock going down in value. So let's say you had, 100 shares of COT, Crazy Options Trader stock, and it was valued at $100 a share. And you said, you know what, I'm really liking this stock, but if it ever goes down below 90, I don't want it ever to go below 90. So I'll buy a put that says that if it ever goes below 90, I'm guaranteed to sell it to someone for 90. And that's how it basically works. So it's an insurance policy. It says it's going to insure a certain part of that stock. That's how puts started, of course. So let's talk about an example. So again, COT stock is trading at $10 a share. Let's use this example. And I can buy the put option to sell the stock at $10, and I pay $1 for the option. So I'm paying someone $1 for the option that says that they will guarantee that they will buy the stock at $10. The option gives me 3 months. In this case, it's just a 3-month option. It could be less. It could be more. If the stock goes down to $7.50 a share, I made a $1.50 profit. All right, let's go through the math. If it's at $7.50, the current value, minus $10, the price I could sell it for, that's a $2.50 gross profit. Of course, I paid $1 for the option, so my net profit is $1.50. All right. Don't get confused about the idea of selling a stock you don't own. It's a little complicated when you're thinking, well, how can I sell a stock if I don't own it? Well, remember, with stock options, you have 3 choices. You can execute, expire, or sell. So what we're doing here as a trader, our concept is we're going to sell the options, not the stocks. So let's just get rid of the option and not worry about having to sell the stock. Now, I'm going to tell you that if you decide to execute the option and sell the stock, guess what you have to do? You have to buy the stock after you sell the stock. I know that's kind of backwards, isn't it? But you have to balance your account. So if you sell the stock for $10 and you have to buy the stock for $7.50, you still keep the $2.50 difference, but that's the point. Don't execute the stock. Don't execute the option in either call or put options. Don't execute them. Just sell them. All right, let's talk about what they look like. So, of course, if you go down to the snap ticket at the bottom of your TD Ameritrade, and by now I'm hoping you have looked at this already. And if we put in, for example, we put in, we click the snap ticket, it opens up. We put in Facebook, my favorite stock, and we take a look at, we click the button chain, and we take a look at the chain. You can see, just like you did before, you're going to see different dates with different expiration dates. And each one of these is going to have more time value. So the longer the expiration, the more premium pay. Okay, this is the same as it was before with calls, but now we're going to talk about puts. And let's pull a March 3rd. So March 3rd puts. Now, if you look on the left side, which is what you're used to looking at, which is the calls side, those were what we talked about in the last module. Let's take a look at to the right side, and let's take a look and see. We're going to look at, again, March 3rd, and these are the put prices. So these are the prices, and these are the strike prices that someone guarantees they're going to buy the stock from you for. All right, you with me? So if you had a 135 135 strike price as a put, and the stock was down to 130, somebody has to guarantee they're going to buy that stock from you at 135, even though the stock is at 130 now. All right, of course, this is the bid and ask price, just as we talked about in the last episode or the last module. The bid and ask price, the difference between the bid and ask price, of course, is called the spread. And in this case, the spread is 15 cents. All right, going back to what the option chain looked like, again, for March 3rd. If we take a look at a 135 put, let's take a look at this and let's talk about the intrinsic value and the time value in the 135 put. So in this example, at the time, Facebook was selling for $131.87, and these were the puts that were available at the time. Okay, so the ask price is $131.88 is what it could sell for, and a 135 put. Now watch what happens. Again, that's the strike price, and we would pay $12.90, or we would bid $12.90 is the current bid. Of course, the ask price is $13.10. The spread in this case is 20 cents. So you could pretty much bid somewhere in between. I usually tell people to bid 13 at this point, just to see if you can get it. And it looks funny how the last, in this example, the last happened to be 13. All right, but watch how this works. It's the same as, again, it's the same as a call, but it just looks different. All right, so we have the last price that it sold for was $134.19. The put is a 137 put, so someone is guaranteed that they have to buy this for 137, and the intrinsic value, that means, is $2.81. You get it? 137 minus 134.19 is $2.81. So this has intrinsic value. I will tell you that this is pretty good time value, but then again, it's a weekly, so this might be a couple of days before or a week before the time is up, so that's why the time value is so low. But take a look at the time value, right? The time value, it sold for $3.10, is how much the option was. The intrinsic value is $2.81, so the time value is 29 cents. And it works. And remember, the time value is referred to as the premium. All right. I kind of went through this a little fast, and I get it, but you have to understand that the most important thing about puts is that the further negative you are from the strike price, the more the option is worth, which is the opposite of calls. The higher you are away from the strike price is better for you. In a put, the further away negative you are is good for you. So that's basically how puts work. I want to talk about some other terms, so we have them down. We have in the money, near the money, and out of the money options. Of course, if you read the ebook, you've got a kind of a feel for this, but I just want to go over it with you just to make sure you fully understand it. All right. In the money is real simple. It's an option with intrinsic value. It means that it has some intrinsic value. For example, if you're buying a stock that if it's a call and the strike price is 130 and the stock is currently worth 131, it's considered in the money with intrinsic value of $1. So that's in the money. Okay. So if you're going to take a look at this, you can see that when on TD Ameritrade, what they do is they actually put the yellow, see the yellow highlight? That means those are in the money options. So that means that you have some intrinsic value in these options already. I think I've said this before. I like buying in the money options because it gives me a more warm and fuzzy feeling about knowing that there's some value to my option and it'll probably never hit zero. Can it? Yes, but it probably will never hit zero. So if I spend $1,000 on an option to buy an option, a couple of shares, a couple of contracts, then I know right away that I'm not going to get burned because it has some intrinsic value already in it. Okay, here's near the money. And near the money is basically an option that's almost in the money. It's very close, and I'll give you an example of that again. So 134.72 is what the stock was selling for in this example, and you can see that how close these are. These are really close to in the money. Look at this. The 133 put, right, says that if the last price was 133.72, it's 72 cents away from being in the money. The same thing with the call. It's about 30 cents, 28 cents actually, away from being in the first call. So that's what would be near the money. Not in the money, but near the money. Okay, to select a range, you would simply go to your TD Ameritrade, click that button, hit the drop-down menu, and click near the money. Of course, out of the money is an option that's far from intrinsic value. So there's a lot of way. You have to go pretty far to get to it. So you can see some of these out of the money options, and look how cheap they are. If you look at the 143 call, the one at the bottom, you can see how cheap they are. By the way, to get to the range, you simply highlight that, click the button. You just click the button, and you'll drop down to out of the money, and here's your out of the money. But if you're looking at the 143 call, the 143 call has a really cheap price because it's not likely to get there. But hey, it's a nice gamble, right? You could put a whole lot of money on that, and if it happens, you make a whole lot of money. But unfortunately, it doesn't happen often. So again, I might look at numbers that are closer to in the money than how far out of the money they are. But look at the difference in premiums. The premiums are pretty cheap when you're out of the money. But I will tell you that as one of my rules, if you buy out of the money options often, you will soon be out of money. And that really is the truth, because buying out of the money options really it's worse than gambling. Gambling over earnings is, there's a chance. Buying out of the money often, it's really like winning the lottery. All right, of course, if you haven't taken a look at the rules of the Crazy Options Trader, make sure you look them over again. If you've looked at them, well, make sure you look at them for the first time, because you want to start. Now you're going to start trading soon, and I want you to know the rules. Okay? Don't forget, it's time to start trading. If you haven't set up your account, please set it up and please fund it. Also, have we had our first coaching session yet? If we've not, please contact me and let's get our first coaching session going. If we haven't had our second, that's fine too, or third, or whatever, depending on the program you're on. Let's get into the coaching so we can get you going on this. All right, and make sure you contact me all the time. Make sure I have your cell phone number so I can text you with some good buys and sells. I hope you enjoyed this module, and I'm looking forward to showing you the next one. Have an awesome and profitable week.